credit market activity declined significantly relative to a steady first half, driven by a muted July issuance followed by an improved August and September. Despite fewer issuers participating, debt capital market auctions were held across most sectors, resulting in a total issuance of 29.2 billion. Issuance was dominated by the financial sector, accounting for 49% of Q3 volumes, while the corporate sector contributed 24%. The SOE and municipal sector were absent during the quarter. Total term issuance year to date amounted to 110 billion. Following the decline in the issuance, total secondary market trading volume was recorded at 29.8 billion for the quarter, down 9.4% from Q2. Financials were the dominant sector. The Big Four banks remain key issuers in the market, with senior Tier 2 and additional Tier 1 paper, focused around sustainably linked and green notes, which has been a growing trend. AT1 spreads continue to tumble, with First Rand issuing paper at a record low margin of 296 bips. We saw successful inaugural auctions from New Development Bank raising 1.5 billion and AECI Limited raising 1 billion sustainably linked bond. Furthermore, we saw total issuance of 2.7 billion by SA REITs, notably from Redefined Properties, Siphokuhle Property Fund and Fortress REIT. As has been the theme for the first half of the year, spreads continued tightening across the board due to the market being characterized by high demand and limited supply amid high policy rates. Bid cover ratios remained elevated throughout the quarter, leading us to believe that spread compression is due to higher demand rather than underlying credit fundamentals. Our proprietary credit rating tool assesses the default probabilities of over 200 counters. Analysis indicate that these largely remain stable, corporates showing the most notable improvement, albeit off an elevated base. Our positioning is driven by a thematic view based off applying a systematic credit cycle cognitive approach that captures the impact of the macro environment. Our credit cycle indicators suggest continued heightened risk levels inherent in the South African credit market, and the fund positioning talks to holding assets with what we believe have defensive characteristics, while opportunistically taking on additional risk as and when this deemed appropriate.